Hello and welcome to the Wright Know Your Money podcast. I'm Ashley Smith.
And I'm Tom Richards.
On the Know Your Money podcast, we talk everything finance, from financial planning tips to how what's going on in the world around you affects the money in your wallet and, most importantly, your financial future.
If this podcast helps you, please like and subscribe so that we can help as many people as possible moving forwards. In today's episode, we're going to be continuing with our inheritance tax mini-series, and this week we're going to explore some of the additional allowances and exemptions that you may qualify for to reduce the amount of inheritance tax your estate could potentially have to pay on your death. The previous podcast looked at what inheritance tax is, the rate at which tax is payable, the inheritance tax allowance, and the main residence allowance. These allowances are the most well known, as everybody qualifies for the standard inheritance tax allowances, and anyone that owns their own home could also qualify for the main residence nil rate band. We use the word could as there is some criteria that needs to be met, which we discussed in the previous podcast. In addition to these allowances, there are some additional allowances and exemptions which, when utilised correctly, can potentially help to reduce your inheritance tax liability on your death. Let's take a look at some of these here. Ashley, could you just start us off with some of the available exemptions?
Yeah, so we'll start here with some of the gifts that you can make to potentially reduce your inheritance tax. So the first one here is the annual exemption. So we spoke in the last podcast about gifts and how when you make these, they potentially are added back into the estate if you die within the first 7 years. However, you can actually give up to £3,000 a year away to anybody you like without having to account for it for inheritance tax purposes, even if you then pass away within 7 years. Now, unfortunately, that's £3,000 per person making the gift, not £3,000 gifts to multiple people. So for example, if you made a £2,000 gift to one person, it leaves you with £1,000 that you can gift to somebody else. If you haven't used this gift allowance in the last tax year, you can carry it forward 1 year. So if you haven't used it in the last tax year, this year effectively you have £6,000. If you're a married couple, each individual gets that allowance. So potentially between you, you've got £3,000 each, which is £6,000. And if you haven't used that gift allowance for the last tax year, there's £12,000 you could possibly gift there. The second for these gift allowances is a small gift exemption. So in addition to that £3,000 annual gift, you can actually make small gifts of up to £250 to as many people as you like. So that will cover usually when you sort of give people gifts or money for birthdays, Christmases. You don't then have to go back and account for that in your inheritance tax forms if you were to pass away. You can't unfortunately use the 3,000 or part of that 3,000 annual allowance exemption, with the same person as the 250. So if you give somebody 3,000, you can't then give them another 250 on top of that. The third of these gift allowances is for weddings or civil partnerships. So when somebody is getting married, you can give them a gift of a value of or simply cash, up to certain limits depending upon your relationship to the happy couple. So if you're the parent, you can give cash or gifts worth up to £5,000 and you don't need to account for it for inheritance tax. If you're a grandparent, it's £2,500. Anyone else, friends, relatives, can give up to £1,000 as a gift for a wedding. The gift itself has to be made, or a promise to make it, on or shortly before the date of the wedding or the civil partnership ceremony. It's quite loose there. There is no sort of set time period, but obviously if somebody got married and then 10 years later you decide to give them a gift, it's probably not going to fall into that exemption. You can combine the wedding gift and the wedding and civil partnership gift. So, for example, there, if your child is getting married, you could give them the £5,000 gift for the wedding plus the £3,000 gift under the annual exemption as well. The fourth and final one of these sort of gift exemptions is gifts out of regular income. So this is often an overlooked allowance, as there's no real set amount, there's no time frames, there's no sort of specific criteria when it comes to physically how much, but there is some criteria that defines what a gift out of regular income is. So it has to be a gift out of the income that you receive. You have to be able to afford to give that gift without it affecting your own lifestyle and stopping you from meeting your own expenditure needs. The income that gets classified as regular income, it can't be an income from your savings. So if you had an income coming in of, let's say, £1,000 a month, and then you're drawing another £4,000 from your savings, you couldn't then give that £4,000 per month to children or grandchildren, whoever, because it's not really a gift out of income, it's a gift out of capital.
Yeah.
Okay, so whilst there's no set amount, there is a bit of criteria in terms of how we work out whether or not it's a gift out of income.
That's fantastic. Thank you very much for that, Ash. So there's 4 different ways you could potentially gift to your beneficiaries and have those gift exemptions from inheritance tax. In addition to this, there are some additional reliefs that you as our client could qualify for when calculating the estate for inheritance tax. Ashley, could you now just run through these for the listeners?
I can, yes. So before I detail these, just like to note, point of technicality here, that these aren't sort of exemptions as such. They're not free of inheritance tax. Instead, they have an inheritance tax rate of 0%.
Yeah.
Now, whilst that may seem like a sort of a technicality or an irrelevant point, it's actually very important when it comes to calculating the total value of the estate for the main residence nil rate band. So as you may or may not remember from the last podcast, we said that when you look at your main residence nil rate band, you sort of calculate the entire estate, and if your total estate is over 2 million, that allowance starts to reduce by £2 for every pound. Sorry, for £1 for every £2 that you're over that amount. Now, with these allowances that I'm about to go through in a second, or these reliefs I'm about to go through in a second, although they have a 0% tax rate themselves, they still get added to your estate when working out that 2 million for the main residence nil rate band. So just keep that in mind.
Yeah.
So the first one is business relief, or sometimes known as business property relief. So if you own a business or a share of a business, you may be able to pass it on without paying tax or having a 0% tax rate. And to qualify for business relief, you must have owned the business or the business assets for at least 2 out of the last 5 years before your death. There is an exception to this. So if you inherit a business from your spouse and you own it for less than 2 years before you pass away, they look at the combined ownership period between spouses. It's not just you as an individual.
Yeah.
Not every business will qualify for business relief. So if we look at, first of all, at those that do qualify, so generally it needs to be a business or a business interest that's classed as a trading business. What I mean by that is 2 very brief types of business. You have a trading business and an investment business. An investment business would be something that only really exists, or an investment company that only really exists to invest in, say, property or equity or shares. A trading business is usually a business that is trading as a going concern, so financial advisors, for example, and electricians, plumbers, an engineering company, whatever that business is. The thing that will qualify is unlisted shares, so shares that aren't listed on a recognised stock exchange, including those actually that are traded on the AIM, as some people know it, or the alternative investment market. Holding of shares or securities that give you control of a company that are fully listed on a recognised stock exchange, that would also qualify. Any land, buildings, plants or machinery that you own that are used wholly or mainly for the business during the last 2 years that the business was passed on. So that one, quite an important point here. If your business is an investment business that just buys and rents out, or buys and sells property, it's not going to qualify. But if you're a trading business that does hold its own office blocks or its own factories, its own machinery that is wholly and exclusively for that business, then yes, that will qualify. Okay. And also any land or buildings that your business has held in a trust that you have the right to benefit from, that would qualify as well. So generally, if you do not meet that criteria, you're not going to meet, or you're not going to qualify for business relief. For a bit of clarity, some specific examples, it's obviously not endless here, but some specific examples of businesses that wouldn't qualify. One I've already mentioned here, but businesses that mainly deal, sort of investment companies, so mainly deal with securities, stocks, shares, land, buildings that are trying to sort of buying and then holding for rent or to buy and sell, that wouldn't qualify. If the business is a not-for-profit organisation, that wouldn't qualify either. A company that's being wound up, unless it's part of the process to actually enable the business of the company to carry on, that wouldn't qualify. If the assets qualify for agricultural relief, it doesn't qualify for big business relief, but it will qualify for agricultural relief. So, agricultural relief then. So we've done the business relief, the next one, agricultural. So for an agricultural property to qualify, it needs to be located in the UK, the Channel Islands or the Isle of Man, or as it currently stands, the European Economic Area, and it must be part of a working farm. Okay, you must have owned and occupied the property for agricultural purposes for 2 years before your death to qualify. If you've let that property out in the 2 years before your death, you must have owned it for at least 7 years before your death. Okay. There's also then what we call woodland relief. So if you own woodland, the value of the timber is excluded from the estate, or has a 0% tax rate, but the land itself is not. Okay, the land itself is taxable for inheritance tax. Okay, so if the timber is sort of chopped down, it's sold, and you now hold the cash, fortunately that comes back into the estate for inheritance tax purposes. So that one's quite a tricky one there, and if you do own woodland, it might be worth having a chat to a financial advisor or your accountant on that one there. The woodland might also qualify for agricultural relief if it's part of a working farm, or business relief if it's actually part of a business. So again, working out which is the best sort of relief to claim on that one, probably a discussion for your solicitor or somebody, your legal representative, when it comes to actually completing the paperwork. Final one that I've got here is heritage relief. So if you own something of historical scientific interest, that could have a 0% inheritance tax rate as well. Some examples there, buildings of outstanding historical or architectural interest, or objects with a national scientific, historical or artistic interest as well. If the value of these assets are in excess of the threshold and don't qualify for any of the reliefs or exemptions, then you'll need to take action to prevent them, with sort of the value being eroded on death due to inheritance tax, and that's where we can come on to in the next sections of this mini-series about saying, well, if we don't qualify for any of those allowances or reliefs and we've exceeded our threshold, what can we do to possibly reduce or pay that inheritance tax so that the estate or the beneficiaries don't have to. If you'd like Howard Wright to assess your inheritance tax position, any reliefs or exemptions that you may qualify for, and recommend actions for how you then can mitigate any of your potential inheritance tax liability, as always, please contact myself or any of the chartered financial planners here at Howard Wright. The best way to do so is via the website at www.howardwright.co.uk and fill in our inquiry form, or contact us on phone 0345 688 4939. Thank you very much for listening to the Howard Wright Know Your Money podcast. I've been Ashley Smith.
And I've been Tom Richards.
If you're watching this on YouTube, please like, subscribe or share on your socials. And if you're listening to us on Apple Music or Spotify, please drop us a follow and leave us a review.
It really helps other people find the podcast, enabling them to know their money better and build stronger financial futures moving forwards. Please also make sure to check out the Howard Wright link tree below for loads more tips, tricks and articles and videos just like this one.
And most importantly, stay tuned for future episodes. This recording contains information from sources believed to be reliable, but no guarantee, warranty or representation express or implied is given to its accuracy. Howard Wright does not undertake any obligation to update or revise any future statements. Past performance is not a reliable indicator of future results. Investments can go down as well as up, and actual results could differ materially from those anticipated. This recording is for the information purposes only and has no regard to the specific investment objectives or financial situation of any individual. The information contained in this recording is not intended to constitute and should not be construed as investment or financial advice. Appropriate personalised advice should always be taken before entering into any transactions. No responsibility can be accepted for any loss arising from action taken or refrain from being taken based on this publication. Howard Wright is authorised and regulated by the Financial Conduct Authority.